In this video, we are going to focus on the 1-hour time frame. I will show you how to read price movements, understand intraday bias, and find high probability setups using this time frame. So let's get into the video. So how are we actually going to use the 1-hour time frame? The way I personally use it is very similar to the 4-hour, but a bit more refined. The 1-hour is where I look for more precise points of interest that can give me higher probability trades with better win rate. So let's go through this step by step so you understand how everything connects. Starting from a top-down perspective, if you look at the chart during the Asia session, what do we have? We are on the 1-hour time frame and we can clearly see two fair value gaps. So the first thing I do is mark out both of those fair value gaps because those are my key areas where price can react from. Now there's more context here. You can see that highs have already been swept, which already gives a bearish tone for the day, and at the same time we have equal lows resting below price, which becomes our draw on liquidity. So now I have a clear idea. Bias is bearish, draw is lower, and I have my 1-hour points of interest marked. Now I drop down to the 5-minute time frame to refine the setup. What am I waiting for on the 5-minute? I want price to retrace back into one of those hourly fair value gaps. And ideally I want it to tap into the bearish one, because it aligns with my bias and the draw on liquidity. So as price develops, you can see that it comes up into that bearish fair value gap and also sweeps a high. Now this is important. I'm not entering at the sweep. I'm not rushing anything. I'm waiting for confirmation. So the next thing I want to see is a 5-minute fair value gap form after that reaction. And as you can see, we do get a 5-minute fair value gap. So now I mark that out and move down to the 1-minute time frame for execution. On the 1 minute, what am I looking for? I'm waiting for price to retrace back into that 5-minute fair value gap and then give me an inversion fair value gap or some form of confirmation. And as price moves forward, we do get that exact condition. We get a 1-minute inversion fair value gap. Now everything is aligned. We have higher time frame bias from the 1 hour. We have a reaction from a 1-hour fair value gap. We have a 5-minute fair value gap. And now we have 1-minute confirmation. So this is where I execute entry is taken at that inversion fair value gap. Stop loss goes above the candle high, and the target is the equal lows resting below. And as you can see, price moves cleanly and delivers straight into that target. And that's all you really need for the day. One clean setup, aligned across time frames, executed with patience and confirmation. So this is how you use the 1-hour time frame, not for entries, but to frame your bias and identify your key areas. And then you refine everything down to the lower time frames for execution. Here we have one more example, and this one is slightly different because now we're dealing with continuation instead of a reversal. But the same logic still applies. So first, what do we see? Price has already swept the equal lows from the previous setup, and after taking that sell-side liquidity, instead of reversing lower again, price starts pushing higher. So now the narrative changes. We are no longer looking for sells. We are looking for continuation to the upside. And this is very important. You always adapt to what price is doing, not what you initially expected. So now that price is pushing higher, we have a new range forming, and we shift our focus accordingly on the 1-hour time frame. What do we have? We have a 4 a.m. hourly fair value gap. And you can see that price retraces back into that fair value gap right around the pre-market open, near the 7 a.m. candle. So now that becomes our new point of interest. Once price taps into that area, we move down to the 5-minute time frame. What are we looking for now? We want to see a 5-minute fair value gap form after that reaction because that gives us a refined area to work with. And as you can see, we do get that 5-minute fair value gap. Not only that, we also get a liquidity sweep of the low within that move, which adds even more confirmation. So now we have confluence hourly fair value gap, 5-minute fair value gap, and a liquidity sweep. Now we move down to the 1-minute time frame for execution. On the 1 minute, you can see we get a clear change in state of delivery. Now at this point, you actually have two options. You can enter aggressively on that shift itself because everything is already aligned. Or if you want a more conservative entry, you can wait for price to form and then invert a fair value gap. And as you can see, price eventually does give you that inversion. So once that happens, that becomes your entry point. Stop loss goes below the recent low, and your target is the opposing liquidity, or highs, resting above. And as you can see, price moves cleanly and delivers straight into those targets. So this example shows you that the same framework works for continuation. As well, you identify your higher time frame point of interest. Wait for price to react. Refine it on lower time frames. Get confirmation. And then execute. And once you start understanding this flow, you'll be able to trade both reversals and continuations with the same model and the same confidence. So that's how you use the 1 hour time frame, not just for reversals, but also for continuation trades. Once you understand how to read price after liquidity has been taken, you can easily adapt your bias and trade in the direction the market is actually moving. The key is always the same: higher time frame point of interest, lower time frame confirmation, and clean execution with patience. Don't rush entries, don't force trades, just wait for everything to align and let the market come to you. And when you stay consistent with this process, you'll start to see how smooth and repeatable these setups really are. If you found this helpful, make sure to like and subscribe, and I'll see you in the next one.